After the clocking in the highest ever year for all line items in FY23, Cummins India has delivered a very strong growth in quarter one FY24 as well, albeit in a line item or two, it may have been lower than the Bloomberg estimates, but a 30% jump in or uptake in revenues, EBITDA expanding much more than that, and expansion in margins happening as well. I would take that Mr. Ashwath Ram would be a happy man. He joins in right now to talk about the quarter gone by and the outlook for the year ahead. Mr. Ram, good having you. Thanks for joining the show today. And what went behind the quarter? Almost all line items are looking healthy. Is this as per your expectations?
Yeah, I think the dominant factor in this quarter has been the pre-buy in the domestic power generation market. We were able to deliver a substantial amount of material out to our OEMs and to customers, despite all the supply chain challenges that we've been facing over the years. We also were able to launch the entire range of products for CPCB 4+. So I would say overall we are kind of little tired from having delivered a very big quarter, and now are preparing and working on how to continue to keep up the momentum that we've been having for the last little more than 2 years.
Would it be a difficult task considering that the CPCB emission norms are changing from July 1st, and you had a large dominant portfolio in the sub 800 kV segment? So what happens now that the norms have changed?
Like you mentioned, we had a great portfolio even for CPCB 2, and we think the portfolio at CPCB 4 is even great, even better. And what we were hoping for is that with the launch of CPCB 4+, that because it's an incremental technology in terms of sophistication, cost, capability, everything, it's a more expensive product. So we were expecting some level of volume correction to happen for at least a couple of quarters. Now, what has happened is that with this decision by CPCB, it has pretty much pushed out a complete transition to July 1 of 2024. And that means we are going to have to run 2 product profiles through the system during that period. We expect some markets to continue to buy the CPCB 2 products, which are already all scaled up and suppliers ready and tooled up and ready to go. We just have to, start producing more inventory there. And then as we scale up CPCB 4+, we expect that some market segments, especially in the Delhi NCR region, in states like Tamil Nadu and Maharashtra and few other states, which have been asking genset users to move to either alternate fuels or move to retrofit emission control devices. We expect all of those kinds of customers to move to CPCB 4+. So it's going to be a mixed bag for the next at least 3 quarters. And but it's not bad for business. I mean, demand does not go away. As a matter of fact, there's an opportunity to increase demand with this dual product kind of scenario.
Oh, but my bad, I stand corrected, because I thought the new norms are effective starting July 1st, 2023. In certain pockets, you're saying they have been pushed out, which I was not aware of, so my bad. But I'd still like to bring in the question of what could happen to volumes considering that part change will still be effective, because you had such a strong volume number because of pre-buying. Would there be a natural curve down on volumes and demand for the next 1 or 2 quarters?
Certainly for 1 quarter, because we have pumped in a lot of material into the market. So as that inventory gets depleted, then and we start pushing for more orders, it'll be a inventory depletion cycle and a production scale up cycle.
Okay, so July, August, September might be a slightly iffy quarter on volumes by virtue of this. what happens post-September is still out in the open, I reckon.
That's correct. The demand
Okay, great.
in the market itself is quite strong. So there is no dip there. So, but what material we have already built into the inventory, that'll get depleted at a pretty rapid rate.
I get your point. Since we're on the topic of sales, I'm just trying to get in a couple of points that are there in your annual report as well, observed by some brokerages. I read a couple of excerpts, and one of the notes suggested that the sales sanction with Cummins UK that suggests visibility for a minimum 20% growth in exports, a 50% YOY increase in the proposed quantum of sales transactions with UK, and therefore on your overall base, that's suggests about a 20% growth in exports for the year or maybe the next few years. Would that be a fair assessment? And are you happy with that, or would you want a slight more traction on the export side?
So we are continuously trying to improve exports. As you've seen from the numbers, the last, I would say, almost 8 quarters, we have seen sequential rise in exports. And we are trying different ways of trying to get more business globally. We are introducing new products. So we are trying to reduce our costs. We are improving the quality. We are trying to do customized fit for market products for each of the regions. Yeah, Cummins is looking at all of that globally and trying to figure out, how to utilize India better to help it improve its market share as well as its profitability around the world. So that exercise continues. We are never happy. We always want more. So from that token, I think we have made a start, and we will continue that work, looking at market segment and region by region, trying to do more.
A clutch of global MNCs, Mr. Ram, have told me that the narrative is changing in that global MNCs are saying make in India, for India, and for the rest of the world. Now, and therefore MNCs are able to take large capex, because even if Indian market doesn't absorb it, the global markets would. I have seen that in your case as well. I mean, the capital commitments suggest a sharp uptick in capex as well. Is this something that you are seeing within the Cummins ecosystem as well?
So Cummins has always used Cummins India as a base for exports. Also, in addition to meeting the domestic demand. And we've been working on this not today, but we've been working on this for the last 30-40 years. Right. And so a big chunk of what Cummins utilizes in many markets, including in power generation, even in some industrial markets, is procured from India. So as we change the product profile there, as we expand capacity, as we move to next generation products, investments are being made in 3 parts. The first part is, of course, to upgrade the products and get the latest technology and the best performing products. So there's a whole bunch of work which happens in emissions and growth, in entering into new markets, etc. So that uses up an extent of capex. The second area of capex is what we call sustenance capex. You've got to keep the house running. You've got to build more. You've got to optimize the factories. You've got to do those kinds of things. That is what we call sustenance capex. And the third is what is incremental new capex for areas where we don't have significant presence or capacity today. And those would be the 3 buckets in which we would be deploying capital as we move forward. But certainly the opportunities seem to be increasing. And there are, of course, ups and downs in different regions around the world as far as demand is concerned, but the overall trends, to me at least, appear positive.
So you expect a circa 20% growth or more as a base for FY24 or FY23 maybe? Would that be a possibility?
Not necessarily for the overall whole business. What we have been guiding is that we are aspiring to grow the business at 2x of the GDP. Now, we have been outperforming that in the last 2 years, and we have gotten 18 and 20% growth, etc. But this year, with certain markets softening globally, we still think we will be able to beat our own estimate of growing 2x of GDP.
Okay. So it's a bit of a wait and watch currently because the global situation is a bit fluid. Would that be a fair assessment?
Yeah, but when I look at if you look at a long-term trend, if you look at now, 5 years of our company, you will see that year on year the growth is pretty significant, and even if the rate of growth has been better in some years, we are still growing. We are going to grow significantly more than where we were even in the previous year. It's just there's a little bit of uncertainty in some of the global markets, and we are figuring out the strategy on how to overcome that. And our ambition, of course, is to grow better than what we are committing to grow. So that's the constant challenge, to try to figure out how to do better than what we are forecasting.
Sure. And I'm guessing there is also a constant challenge to try and grow in a more profitable fashion. So you kind of displayed some of it in the quarter itself, wherein the margins have gone up. Now, was this because of the buoyancy in sales and operating leverage coming into play, or is this kind of a new normal that you believe you can be at, the 15% odd mark?
So the model we have subscribed to for ourselves from a strategy perspective is what we are calling profitable growth, which means we will not just grow top line at the expense of the bottom line. And what we committed is that year on year, we aspire to have 100 basis points of improvement in profitability. And so all focus from our side on cost management, efficiency, new product launches, introduction, everything is geared towards ensuring that we are able to continue to improve the bottom line as well along with the top line. So if you look at the first quarter, actually the previous quarter we had better profitability results as compared to this quarter. But when you look at it from a year-on-year basis, we continue to expand the profit margin in line with what our stated objectives are.
So, okay, here's what I'd love to understand, Mr. Ram. Your cost structure, as I read again in the annual report and then the analysis thereof, the declining share of employee cost and the parent payout as well. Employee cost, I believe, as a share of sales is down 180 basis points versus pre-COVID. Your business plus employees gone up some 50-60% in that period. And I believe the royalty plus support services also come off quite significantly. If I'm not wrong, 1.7, 1.8 times percentage of sales. So my question is, there are these efficiencies in play, but in a year wherein the global situation is looking a bit fluid and you're coming off on the back of a very strong Q1, do you reckon this 15% is something that you can maintain as an average for the year?
I think so. I think we can do that, mainly because in this quarter we have actually grown operating margin as compared to even the previous quarter, which was the best ever. We had these one-time items related to payroll as well as some cross charges in terms of management fee, etc., which we typically get that break in the Q4 when the year-end adjustments happen. So I think we are well on track to being able to hit our profitability numbers.
Okay, that's enthusing. So this would happen even in a scenario wherein commodities have just started to stop declining and maybe going up a bit. You still believe all these efficiencies will enable you to kind of maintain this as an average?
Yes, I believe so. At this stage, we are pretty confident that we can do that.
Okay. One final question, Mr. Ram, and which is based on whatever you see within the domestic ecosystem, because there's a lot of chatter about the government Capex versus the private Capex, and what could follow in the next 12 to 24 months. And even in the private side, a lot of specific industries are doing some fairly high-paced Capex as well. So what is your sense on what's happening in that sphere, and how would you look to take advantage of it over a 24 to a 36-month period?
Yeah, so the 24 to 36-month outlook is very, very positive because by the end of this decade, if we have to reach the economy has to become a 6 trillion plus economy, you need to spend at least a trillion and a half on infrastructure itself. And so whether a big chunk of that we think will still continue to come through the government Capex. But private Capex, let's say in the steel industry, we are seeing it in power generation, we are seeing it in solar, in a whole bunch of those kinds of areas, is also leading to growth in demand of gensets, construction machinery, and a whole bunch of equipment in mining, marine, etc. So the long-term trends, I think I'm extremely bullish on. It's only the short-term, few quarters which, because of the global scenario, is a little bit uncertain.
Okay. Well, that's music to the ears. Mr. Ram, we have taken 15 minutes of your time, so we'll let you go. But congratulations on what I thought actually was a very good quarter. I'm happy to hear about the Capex, about the margin performance and the growth ahead. All the best for Q2 and the quarters ahead.
Thank you.
Thank you for joining in, viewers. Thanks for tuning in.